Good morning, everyone. Today I'm pleased to present our financial ratio analysis report. This is our group member 秦锦熙、郑亚琪、白胜伟、董峰硕. Our research focuses on the Malaysian telephone communication industry, specifically comparing maxis per head and Celcom DJ per head. The data analyzed covers the year from 2022 to 2024. First, liquidity ratio analysis. First, recording liquidity. Maxis has shown a downward trend in both current and quick ratio, decreasing from 0.58 in 2022 to 0.52 in 2024, which is below the industry average of 0.55. Although Celcom DJ also has a quick ratio of 0.52, Maxis decreasing trade risks concerns over its short-term surveillance and working capital inferences. Next, asset management inferences analysis. Next, for asset management, Maxis demonstrates continued improvement in both total asset turnover and fixed asset turnover, outperforming Celcom DJ in 2024. However, Maxis days sales outstanding in 83.66 days, which is significantly longer than Celcom DJ 62.95 days. This suggests influences in receivable collection and relatively lax credit policy. Debt management ratio. In terms of leverage, Maxis debt to equity ratio is 1.57, higher than Celcom DJ's 1.22. However, its overall debt ratio is lower at 41.61% compared to Celcom DJ's 55.04%, and its interest coverage ratio is stronger at 4.83 versus 2.85. This indicates that although Maxis is more leveraged in equity teams, it manages interest obligation more effectively.
The number 4 is profitability ratio analysis. Looking at profitability, Maxis outperformed Celcom DJ across all key indicators in 2024. Its net profit margin is 13.48%. Return on asset is 6.25%, and return on equity 23.64%. Are all significantly higher than both the industry average and Celcom DG. This demonstrates strong profitability and operation efficiency. However, the fluctuations in previous year remind us of the need to maintain consistency in earnings. The 5 is market value ratio. In terms of market valuation, Maxis has a lower P ratio is 20.5 than Celcom DG is 30.9. Despite its better profitability, this indicates that investors may be more optimistic about Celcom DG's future earnings. Maxis PB ratio is 4.78 is higher, suggesting higher market valuation of its assets, but it may also reflect possible overvaluation risks. and the growth rate to 1 is revenue growth slowing, declining yearly, now at 3.5%. Below industries is 4.76%. 2 is possibility rebound. Net profit turns positive is plus 3.8% in 2024 after 2 years of losses. 3 is EBITDA recovery jumped to 4.09% in 2024 is up 4.18%. Beating industry average is 1.997%. 6 is DuPont analysis. Through DuPont analysis, Maxis achieves a high ROE of 23.95% in 2024, far exceeding Cellcom DG's 8.52%. This result stems from stronger profit margins, higher asset turnover, and a greater equity multiplier. While this is a positive sign, the company must manage financial leverage carefully to avoid increasing long-term risk.
Next part is comparison with Cellcom DG and suggested solutions. From our comparison with Cellcom DG, we identified several crucial issues for Maxis, along with suggested solutions. First issue is liquidity issues. The problem is weakening short-term solvency, declining liquidity ratios. The solution is strengthen cash flow management, shorten collection cycles, and restructure short-term assets. The second is asset management issues. Problem is long DSO, slow receivables collection. The solution is tighten credit terms, improving billing process, and increase cash collection efficiency. Next is debt management issues. Problem is high debt to equity ratio and reliance on leverage. The solution is rebalance capital structure through retained earnings or equity financing and control borrowing levels. Next is profitability issues. The problem is fluctuating income trends despite strong 2024 performance. Solution is focused on high margin service, streamlined cost structure, and stabilized recurring income streams.
Okay, now let's focus on the fifth ratio's market value. Our EPS is 0.041 ringgit, slightly higher than DG's 0.04, showing solid equity management. However, our P ratios is just 20.5 compared to DG's 30.9. This indicates that investors are concerned about our future growth potential, like due to our high leverage and high legacy-heavy business model. Meanwhile, our PE ratio is very high at 4.78, while DG's is 2.64. That may seem like the market is giving our assets high premium, but in reality, our fixed assets turnover is only 0.59, suggesting low efficiency. So we are in an old place, high asset valuation, but low investor confidence. This issue here is investor, driven by high leverage, slow digital transformation, and over reliance on traditional telecom revenues. So how to solve it? We need to lower our debt to equity ratios to below 1.2, unlock hidden asset value, and consider divesting 5G infrastructure to free up capital. And next one is growth ratios. Maxis has delivered strong numbers. Revenue grew by 3.5%, net profit increased by 38%, and the EBITDA growth rose by 4.09%. while DG's decline. These figures are clearly above industry average, but here's the catch: this growth is still mainly driven by traditional service. Our digital business remains too small to move the needle. We also face structural challenge like cost rigidity, unbalanced capital allocation. In short, we are growing, but not yet in the right direction. So we are restructuring our business, setting up an independent digital business unit and launching 5G enterprise solution with a 40% price premium. We are optimizing costs through trading equipment plan. And next one is DuPont analysis. High DuPont ROE, but risk compressionlessly. Let's dive into the DuPont analysis, which breaks down the drivers of our return on equity. Our ROE is 23.95%, well, looks impressive at first. But if we dig deeper, most of them is coming from high financial leverage, not operational efficiency. And our net profit margin is strong, is 13.48%, but our asset turnover is only 0.47, much lower than peers. Even more concerning, our equity multiplier is 3.78 compared to DG's 2.22, which means every 1 ringgit of equity is supporting nearly 4 ringgit of assets. That's a highly leveraged model. So we need to reset our leverage. We will issue convertible bonds to replace shorter debt and reduce risk. We also plan to sell redundant base station assets, begin piloting data center development, and use intelligent asset management system to improve turnover. Okay, Masses show strong profitability, efficiency, asset management, and solid financial stability, especially when compared to its main competitor. However, there are clear areas that require attention, such as tightening credit policies, improving receivable collection, and addressing investor, reflected in our low valuation. While Masses have outperformed in earning growth and return ratios, its falling liquidity, fluctuate leverage, and high day sales outstanding point to the need for better operation consistency and financial structure. Going forward, we need to strengthen working capital and receivable management, balance debt and equity to reduce financial risk, improve earning stabilities, and enhancing communication with investors to rebuild confidence. By benchmarking DG's efficiency while capitalize on our superior profitabilities, Masses has a clear path to strengthen its position as a leading high-performance digital service provider. Okay, that's all for today's presentation. Thank you.